Well, good morning, everyone, and welcome to the Francis Financial second quarter 2021 market review. Your speakers for today are myself, Paul Stages. I'm a lead advisor here at Francis Financial, and with me is my very esteemed colleague, Peter Willem. Peter, wave to the folks at
Hello.
home. We have a fun agenda for everyone today. So first, we're going to recap what happened in the investment markets in the second quarter. So in other words, that covers the months of April, May, and June. Then we'll discuss things that are happening right now that might impact the markets in the coming months and how we recommend to plan for that. And then finally, we'll share with you some fun events that are coming up. Sound good? Okay. So we'll get started here. And Peter, I'm going to steal a little bit of your thunder because it looks like it was a really good time to be an investor in the second quarter.
Absolutely. We continued the trends that we've been seeing for the past couple months, which is strong returns, especially in the stock market. And that goes beyond just the US, but also the developed international, which includes countries like Europe, countries in Europe, Australia, Japan, developed nations, as well as emerging market countries like Brazil, Russia, India, China. We saw that continue to do well, as well as also an uptick in the bond market. And a lot of this was due in large part to the reopening of the economy, as we've been seeing here at home and also in countries abroad, as well as the vaccine rollout, which has caused a lot of consumer optimism in a lot of parts of the world. And as you can see, if you just had a nice diversified portfolio investing in a lot of these different countries, that's how you are going to get these strong returns like that 5% that we saw both in developed and emerging countries. That's why we continue to advise to have these diversified portfolios, because if you were to just invest in New Zealand or Chile, you would have missed out on these broad, strong market returns. So while it's great to see, great returns in Denmark and Brazil, having that diversified portfolio to get you through a lot of the turbulence that we saw also last quarter was key. And what we also saw some very interesting information and data regarding the difference between growth stocks and value stocks and their returns. So just as a brief overview, growth stocks are typically stocks that we consider to grow at a faster rate. And a lot of these, think of them almost like technology stocks, like Zoom, Facebook, Apple. They're typically reinvesting a lot of their profits in the company to keep growing, keep continuing their research. And then value companies, on the other hand, are much more established companies, like a Johnson & Johnson, a lot of utility and energy companies. And over the last 10 years, we've seen that these growth companies, with the emergence of a lot of technologies, have done very well. And they particularly did well if we were to look in the peak since February 2020 and since the market low, they've outperformed value stocks by a significant margin. And if someone were to say, okay, I'm going to time the market, I'm going to project that these growth stocks are going to continue to do well through the beginning of this year, that would not necessarily have been the case, as we saw that value stocks actually outperformed growth stocks. And if we take an even longer time horizon with information that's not shown here, we've actually seen over longer time horizons that value has actually outperformed growth. And that's all to say that, it's not that growth stocks are doing better or worse. It all just depends on what time frame you're looking at. If you're looking at since the beginning of the year, absolutely, value's done better, and then growth may do better. But that's to say, we always like to have that nice mix between value and growth stocks to be able to have that diversified portfolio, not to time the market, because we just don't know. Even if a lot of indicators are saying one way or the other, continuing to have exposure on both ends is what leads to those strong overall portfolio returns.
And I definitely see that here, Peter. I'm also seeing that small companies are outperforming larger ones, at least in the value space so far this year. Is that fair to say?
Yeah, that is true, that small companies are doing well, and a lot of that is tied to the reopening of the economy, with all these smaller companies being able to generate more profits. But that's also similar on that growth versus value. It depends on when you look. There will be certain time frames, yes, that small companies will outperform larger companies, but it can be vice versa as well. There will be certain time frames that large companies will outperform, and you can even see it depends on whether it's even a growth or value-based company. So trying to project even beyond, small value, large growth, that really starts to become more of a fool's errand to say, yes, I know which one is going to do better. You might get lucky and then have a strong return, but making sure that you have exposure to all of these different companies to enjoy a robust portfolio growth is really what's going to be important for long-term results.
So it shouldn't necessarily be, pitting one against the other. It shouldn't be growth versus value, but really having growth and value, large and small. Is that? Yeah,
Precisely.
exactly. Yeah. And no surprise, given this strong rebound in prices, especially here in the U.S., what we've seen is that the PE ratio for the S&P 500 is higher than what the historical average has been. And I mean, that trend has been here for quite a while, and it hasn't really meant a slowdown here in the US. And let me take a step back because I did throw out a few acronyms there at everyone. So the S&P 500 is a measurement of, it's an index of the largest 500 publicly traded companies here in the US. So it's a great proxy for how the US stock market is performing. PE ratio, as it says here, it shows how much investors are willing to pay a dollar stock price per earnings. So what we've seen is that right now, this measurement is telling us that possibly US stock prices are a little expensive, meaning that the earnings are a bit less per price of stock than it's typically been. And that could be justified given how low interest rates are, which usually helps companies and helps especially their stock prices. It could also be that investors are expecting earnings to catch up. And so prices have just kind of jumped up ahead and we'll see the earnings come in. Or it could possibly mean that, yes, US stock prices are overinflated and maybe we are due for a little bit of a drop ahead. We don't know. This isn't necessarily a great indicator of what's going to happen in the future, but it is interesting to see, and especially how it relates to non-US stocks, where we're actually seeing the opposite with this PE ratio, where the PE ratio is much less than the historical average for these non-US stocks. So, you could assess this as possibly being a great time to invest and get a good deal. So, it's like going into a department store, you're going in to buy a sweater, you see that it's 20 to 25% off. It's a pretty enticing deal to buy it. So, it's kind of a similar thing that's going on here right now with developed international stock prices. So far we've taken a look at what's happened up until this point. So I think it's a good time to switch gears and discuss what's going on right now and what are the trends that we might be seeing for at least the rest of this year. And as is usual, there's a mixed bag of things going on right now. You've got um, COVID, of course, is the biggest thing looming over the economy and looming over the markets. You've got both good updates of the vaccine rollout and how that's really progressing, especially around the world. But at the same time, you have this new Delta variant. You have some optimistic economic indicators of falling unemployment here in the U.S. and how that's been boosted by some more government spending. But what is that going to mean for government debt? How does inflation possibly play into all of this? And Peter's got some great insights. And we'll also talk about some legislation and where we are there.
Yeah, Paul really hit the nail on the head that it is quite a mixed bag. And starting with some of that good news is that we are continuing to see these vaccine trends go up. And that was really a huge part of what happened in the second quarter. So, April, May, and June, we did see a lot of adults and even children getting vaccinated. So 48% of the population is fully vaccinated, with 59% of people 18 and up fully vaccinated. On the other hand, we have seen cases begin to rise as of recent. So that's something to continue to monitor, as well as the Delta variant, a new, more contagious strain of the COVID variant continuing to spread. And that's all to say that there is a level of uncertainty that does come with having this variant. But we've weathered a lot of other uncertainties in the past. So while we do have this new element that is important to continue to monitor, we'll always look at the longer term. This is something that is to be considered, but we want to make sure that we're investing and we're continuing to think about this as long-term investors. And COVID is not the only story that's going on in the market right now. There has been a lot of strong economic indicators, as Paul's mentioning, falling unemployment, increasing in sales, and a lot of this is due in part to increased government spending. We've been seeing that has really helped move the economy into this post, at least initial COVID world. And we've seen a lot of legislation be passed on top of that to be able to have this economy reopening. And in part, it was this 1.9 trillion American Rescue Plan that saw more than 400 billion in American Rescue Plan coronavirus stimulus checks go out, as well as some first payments and some child tax credits sent out to 60 million families. And the good news about this is going to continue to move forward into 2022. And there are also other updates and other plans that are out there that we touched upon in the last quarter. So there are even further packages beyond this that are going to continue to stimulate the economy, which is great to see.
Yeah, and I think is unemployment now here in the U.S. below 6%? It's around 5.8, 5.9%, Peter.
Mm-hmm.
Yeah, so not quite at the pre-pandemic levels, but definitely making some huge strides there, which again, I think that's helped to kind of bring along and justify some of these higher stock prices that we've been seeing over the last 12 months. Peter mentioned that there have been some other types of packages trying to pass. Haven't been many updates there. If you tuned into our presentation 3 months ago, this slide should look familiar because this is another Biden administration proposal that has not passed through Congress. So this is to increase some of the corporate tax rates, the income tax rates that corporations are paying. So as a reminder, what the Biden administration is hoping to do is to increase from right now about 21% is what many corporations are going to be paying, up to 28%, which is still less than the 35% that there were some levels pre-Trump administration. But so far there hasn't been much movement there. At the same time, they're kind of fighting this two fronts, both here domestically for corporations to pay these taxes, but then also to prevent them from setting up these favorable tax shelters overseas that we've seen happen in the past. So trying to work with other economies, especially ones in Europe, to try to increase and have this so-called minimum tax rate at 21% to prevent them from essentially setting up overseas and taking profits out of the US. Another piece of legislation that hasn't made too many strides just yet is Biden's proposal on overhauling some of the capital gains taxes. So this is how capital gains are treated both during an investor's life and even after death. So as a reminder, whenever you are invested, you have an investment, you hold it for over a year. When you sell it, and if there's a gain on that investment, then you're going to pay capital gains taxes, which generally are at much more favorable levels than your ordinary income tax rate. Well, what the Biden administration is hoping to do is for quote unquote wealthy Americans, those earning over $1 million in a given tax year, that capital gains would essentially be taxed at those ordinary income rates at almost 40% instead of 20%, which is the highest capital gains tax rate. So stay tuned. Investors are looking to see what kind of impact is this going to have, especially as it hits individuals rather than corporations. But at the same time, it's going to be a select few amount of individuals. We haven't seen one way or another the market really react to this.
Yeah, in talking about, stay tuned, one of the things that we've been seeing a lot and has been a huge headline that I'm sure a lot of you have seen has been inflation and what the impact of inflation would mean to a portfolio. And we have seen inflation. That's not to say that there hasn't been any inflation in the second quarter, but we want to spend this time to almost qualify and say, okay, what does this inflation really mean? And let's dig a little bit deeper. And with a lot of experts that we've been talking to in our own research, we've been seeing that not only is this temporary, but it's also relatively in line with historical numbers. As you can see, inflation on an annualized basis had increased to about 3%, but if we look at this, it's not absolutely that much higher than what we've seen in the past 20 or so years. That it has been hovering in between that 2 to 2.8%. So this is in line with historical figures. It's just less than what we've been seeing as of late. And that's because we did see some almost disinflation during this COVID time with a lot of different sectors of the economy, including a lot of these types of sectors that have even gone up recently. So a lot of these things like airline prices, hotels, um, travel services, new and used cars. We've been seeing that that's been contributing the most to this increase in inflation, which actually went down. So almost think of it as it's rebounding back up, and even more so because everyone's been a little pent up. It's been a really long pandemic, so having these travel services begin to open up, there isn't an increase in demand, and there wasn't that supply before, which is increasing these price levels. But as we can see, so much is contributed to those particular sectors, and even some longer term that we've seen outpace typical inflation, like medical services, medical care, actually decreased a little bit. So it's not saying that everything is going up, all prices are the same. It's just ones that we feel are going a lot up too, just because these are things that we're starting to spend more on. We're starting to open up, we're starting to travel a little bit more, we're starting to get more comfortable with these things. So seeing these prices increase has a real emotional and tangible effect, but it doesn't tell the full story of what we're seeing.
Yeah, I've this obviously I've seen this presentation before, and this to me is the most fascinating piece. This is a really interesting deep dive on really what's going on, and I can also see, it's not just headlines of making this up. I can also see as consumers, when we go to buy a new or used car, or we go to finally travel after so many months, to maybe get a little bit of sticker shock. And maybe that's also what's leading into thinking that, okay, is everything going to cost this much more than it did last year or 2 years ago? So is that where you're saying that essentially it's just a few of these key sectors that's leading to this big increase, this temporary, and is it a temporary increase?
Yes, so by all indications, we are seeing these temporary increases because they are these services that almost experienced no demand for such a long period of time,
Mm-hmm.
like used cars, like traveling airfare to a point where it almost went completely 180. We don't expect to see these longer term trends. And even if we do see some continued inflationary patterns based on government spending, we also see some other long-term patterns that almost fight against these long-term inflationary trends. And one of them is China having cheap exports. Another one is an aging population. And then the third one is that the US is actually incentivized to keep inflation down in the long term. And that's because they have certain things on their balance sheet, like Social Security, like Medicare, that are actually pegged to inflation. So they're not necessarily incentivized to decrease their level of debt to foreign nations, because if they do increase the amount, that means that they're going to have to pay more for Social Security. They're going to have to pay more for Medicare. So there are a lot of different factors at play that we see keeping inflation capped for the long term. So even if we do see these short-term spikes that are attributed more to the reopening of the economy rather than potentially the spending plans, there are certain trends that will keep this in line, and incentivizations that we're seeing will really help in that respect.
Well,
And then even beyond inflation,
I was going to say, we've thrown a lot of tough questions at you about, all right, what's going to happen with inflation, and you're you're looking at trends decades into the future, so I appreciate that. But then there's also interest rates too. So what's, if you look into your crystal ball, what are interest rates looking like?
Well, Paul, I wish that I did have a crystal ball, but unfortunately, I don't. So it's great to see. It's great to have these projections, and it's great to think, okay, what's going to happen and what's the Fed saying? And one of the big market narratives was that they're saying we're not increasing rates this year. We're not even increasing rates next year. We're going to increase rates in 2023. And so a lot of experts are saying, okay, that's what's going to happen. These are the certain trends with inflation or with interest rates. And what that means really is that the Fed is showing a sign of optimism, that there is a strong economy that's beginning to reopen that doesn't necessarily need low interest rates to prop itself up. And that is a positive indicator. But
Mhm.
even what I was saying with that crystal ball, even though we all like to think that we can't see into the future, this chart nicely shows you can see the nice green line, which is the actual interest rates, and then you can see that those little brown lines with those dots, those are where experts project interest rates to go within the next handful of years or handful of quarters. And as you can see, almost like clockwork, they're incorrect. It's almost as hard to project what market returns are going to be like than what interest rates are going to end up being. So while we do see some projections that are a little bit higher than the very low interest rates that we're seeing, that doesn't necessarily mean that that's what will come to fruition. And we've seen so much uncertainty, especially recently, the the driving force was interest rates can only go one direction, and that's up. And then the coronavirus hits, and then we actually see it go down. So there's so many uncertain forces at play that being able to project all the way to 2023, it's a good indicator that the Fed thinks that the economy is as strong as it is to be able to withstand that increase, but that's not even necessarily going to be the case.
Yeah, it's interesting to see that of 2018, 2019. At this point, we're about a decade past the Great Recession, so people are thinking, of course, interest rates are going to keep going. And actually, I should mention, these aren't just, when we say experts, these aren't CNBC, this isn't Wall Street Journal. These are folks who work for the Fed, for St. Louis Federal Reserve, for Philadelphia Federal Reserve. So they know their stuff, and at the same time, you can see that you know, human error, bias, whatever you want to call it, very consistently, it looks like they're predicting interest rates to go up, and then something causes them to either not have that as high of an increase or even go down, which tends to be also presents favorable opportunities for investing. So it's really interesting to see this.
Yeah, and it just goes to show that it's very hard to predict not only interest rates, but so much of being an investor is having to withstand uncertainty. And this is one of our favorite charts, is seeing, okay, if you were to just look at this, it almost looks like a jumble of colors. And that's kind of because it is. It's very hard to find a lot of consistency when you're trying to look at this. So what this shows is on an year by year basis from 2009 through 2020, as well as since the beginning of this year ending the second quarter, how did each particular asset class do, whether it was growth stocks, developed international, small stocks. And as you can see, in a lot of ways, it's really hard to project. And even if you see some patterns like commodities being down for a couple of years in a row, if you were to take that at face value and say, okay, one thing that I've seen is commodities being down, I'm going to specifically avoid that asset class, or I'm going to project that to be the case. If you were to look so far this year, you'd see that commodities and in the second quarter actually were the best performing asset class, which is all to say that as an investor, making sure that you have that diversified approach, not saying this one asset class or trying to time the market by saying value or growth or big or small, making sure that you have all of these asset classes incorporated, or at least a good amount of them, to have that diversified portfolio to really reap the benefits.
And this is a great illustration of that, where if you were an investor 30 years ago and you put $1,000 in the market, it would have paid off for you to have stayed in the market every single day, because if you miss out just the S&P 500's best performing day, that cost you $2,000. If you miss the best work week's worth of days, I should say, it's the 5 best days, you would have lost about what, $7,500, so on and so forth. So, and this slide, I have to say, it could be a little intimidating. It shows that if you just happen to miss some of these days, that it costs you money. I like actually the almost, it tells a similar story, but this one to me seems a little bit more optimistic. Of anytime we see these large market declines, which we saw last year, February and March, during the initial onset of COVID and all the economic shutdowns that were happening, we did see, I believe, over a 30% loss for the S&P 500. But That's happened before. It'll happen again for other unprecedented reasons. And then the good news of that is what we've seen is very strong rebounds, not just in 1 year, not just for the next 3 years, but over the next 5 years. So this tells a very promising story of any time we see some sort of market correction that we do then see these brighter, better days. And so, yeah, I always like ending on an optimistic note. I don't know about you, Peter, but I think
Oh,
unless there's anything else to add, I think
no.
um, I think we'll talk about just a few events that are coming up. And so in in 3 months, on Monday, November 1st, we'll be having our next quarterly webinar to wrap up everything that will have happened in the third quarter, and that'll be hosted by our colleagues Devon Barrett and Shweta Lawande. So look out for email invitations to go out so that you can register just as you did for today's webinar. And then really exciting, if you want to continue to stay physically fit as well as financially fit, the wonderful Dr. Laura Miranda, she'll be continuing to host her 30-minute virtual workout classes. So there are 2 dates in August where she'll be doing this. It'll be Thursday, August 12th. So not this Thursday, but next Thursday. And then 2 weeks after that, August 26th. They're only 30 minutes long. It's over Zoom. If you don't want to share your screen, you don't have to, but these definitely saved us during last year, especially when we were in lockdown. So these are fantastic to join if you want to um, get a be part of it. Get a Zoom link. Email the client relations team, and that's clientrelations@francisfinancial.com. And I'll just leave that up for a few seconds. Okay, and then in the meantime, if you have any questions for the team, for us specifically, feel free to give us a call. Our number is 212-374-9008, or you can email us. My email is paul@francisfinancial.com, and Peter's is peter@francisfinancial.com. All right, so with that, we want to thank you again. Huge, big thank you for tuning in, and we look forward to hearing from you soon. Take care, everyone.